Chapter 12, Introduction to Managerial Accounting, Chapter 12, Relevant Costs for Decision Making. Today we're going to make decisions. Well, how excited, right? Why do we need to make decisions? Because simply we have to live. Everybody who lives makes decisions. Part of life, right? What do we need to know to make a decision? Well, so far we cover 11 chapters, which help us bring us to this point to start making decisions. What we did so far, we find out that we're surrounded by costs. Costs, 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 costs. You open your eyes, cost. You close your eyes, costs. You're going outside, cost. You're going to the school, cost. You're going home, cost. You're going to the store, cost. You're going outside on the street, cost. Everywhere, cost. Every day, cost. And we have to deal with those different costs. What is the how many costs we have? Depends on what? On the point of view on which we're looking for those costs. For decision making, we're going to see we have a different type of costs that we have to think about it. But so far we saw that based on the preparation of financial statements, we have a product cost, we have a period cost. The product cost consists direct material, direct labor, manufacturing overhead. Manufacturing overhead consists so many different costs, which is very hard to predict and very hard to estimate. For that reason, we're just doing some basic estimates when we apply manufacturing overhead through the period based on the estimates. What else we have? Based on the how the costs behave, we have variable costs. We have fixed costs, but that's not the end. Now the variable costs can behave two ways as by variable cost per unit, variable cost in total. And variable cost per unit always stayed the same, so that means it's a solid ground. Variable cost per unit in total always goes up or it's adjusted to reflect the usage of the variable cost. Fixed costs, on the other hand, also behave as a total. It's a fixed cost. Total fixed cost is always stays the same. It doesn't changes, but encourage us to use more. So based on there will be certain activity that it's locked by the fixed cost, and then what we have to do, we have to keep using that activity in order to reduce the cost per unit. That's why we have SkyTrain monthly pass. We have other costs, so rental cost, which is log the cost for the accommodation for 1 month. For 1 month, you're paying certain amount. If you have to pay on the variable cost, then if you want to go on the variable cost for the accommodation, you have to go to hotel. And then you're going to see the prices per hotel, they vary from one hotel to another hotel. And if you have to pay day by day, it's going to be a way more expensive than rent for 1 month. So extending the period, you're locking the amount for the period of time. Now what you have to do is have to use that cost. What other costs we have? Direct, indirect cost. Now, basically how we trace the cost to one object to another object, we're going to have direct and indirect. Now we saw for the last chapter for the performance measure. For performance measure, we find out that we have now under the fixed cost, we have two types of fixed costs. We have common cost and we have traceable cost. Traceable cost is the one that always traces to the certain department. And if that department disappears, that cost disappears. But the common cost always stays with the business or stays with you. What will be the common cost for our personal use? That will be cost of living. Can we reduce it? Maybe. Can we increase it? Absolutely. Can we eliminate it? No. At some point, it's going to eliminate itself, but only for us. For those one who remains, that cost is still going to go. So that being said, let's see what we're going to do when we start making decisions, because at some point we have to start making decisions. One of the main management activity was the making decisions. What's the other one? The other one is the planning. Then we have Then we have motivating and directing. Then we have controlling. And one of the main activity, which is the all those different activities management, is the making decisions, decision making. So how we can make decisions? In order we to make decisions, first we have to have alternatives, at least two. If we have only one alternative, there's nothing to do. There's no decision to make. You're just getting what you get and end of the story. What decisions you can make if you want to drive the car in BC. If you want to drive a car in BC, you have to get insurance. Then what decision you have to make? Should I buy insurance from this company? Should I buy insurance from that company? Well, better not make that decision. Our province make it very simple. Just go to ICPC, end of the story. If you want to go to another institution, there's no another institution value. So relevant cost, which is the relevant cost now? Relevant cost will be the one that's different from one this alternative to another alternative. So basically, once we have more than one alternatives, there will be costs which will be different. Avoidable cost is another relevant cost. Avoidable cost is the cost that can be eliminated partially or entirely if one alternative is chosen over another. Avoidable cost is relevant. Unavoidable cost, the cost that cannot be avoided, is never relevant. The broad category of the not relevant or irrelevant costs are sunk cost and cost, which is not different between one alternative and another alternative. Sunk cost is the cost that already happened. We already talked about this in chapter 1, but let's keep again. No, I believe chapter 2 was that. Sunk cost is the cost that already happened. So for example, once you purchase annual insurance of the car, regardless are you going to drive a car or not, that cost is irrelevant. Now, if you decide to go from BC to Alberta, you can just jump in the car and drive. The cost of the insurance is not going to affect your decision. If you decide to go to vacation, the cost of the insurance that you pay for your car is not going to change your decision. You're still going to go. Future cost, which is not different between one alternative, is also irrelevant. For example, if you decide where to go, should I go in Miami or should I go in Hawaii? In both scenarios, you have to go to the airport. In both alternatives, you have to take the cab. The cost of the cab, is it relevant in this situation? Which alternative should I choose? No, it's not. Why? Because the cost of the cab is cost of the cab. In both alternatives, you have to choose it. And you have to pay it. So for that reason, the cost of the cab is eliminated from the making decisions where to go for vacation. Step 1. How we're going to identify the process of how we find out which cost is relevant, which one is not. Step 1. Eliminate the cost and benefits which are not different between one alternative and another alternative. So we're finding first which is the alternative 1, then we're finding which alternative 2, then start comparing cost, benefits from one and another. If we have same cost and same benefit, those are eliminated. Whatever left between both alternatives, we weight those costs and the benefits and make a rational decisions, a rational data-driven decision in the best interest at the moment. Because the moment can change, the reality can change. How fast can change the reality later from our experience very fast. What's happening today, it's one thing. What's going to happen after 1 month? We have to wait for 1 month and see what's going to happen. Now, the cost that remains, those will be the differential, avoidable cost, and some other cost. So let's see now how we're going to make this decision. First, costs which are relevant in one decision, one situation may not be relevant for another context. So we have to be careful on which context we're looking at that cost. So let's try to help this person. This person, she decides to go to a trip with a car. Let's put first the scenario. This person decides to go to her friend to visit a friend. Has to drive or has to travel. Let's put it this travel 230 kilometers back and forth. 300, 230 going there and 230 coming back. Two alternatives. One option is to drive a car. The other option is to take a train. Now we have two alternatives. Now we have to choose one of them. What we're gonna do? We're gonna see this person prepare some information for us based on the cost that she thinking that might be relevant, might be not relevant, and she prepared that report. Now we have to see which of those costs are relevant, which of those of course are not relevant. So let's start first. She put as a cost annual straight line depreciation on the car. What we have to ask ourselves is this: if I use the car, if I'm having the car, right? If I'm using the car, does depreciation goes? Yes, it does. If I don't use the car, does depreciation stops? No, it doesn't. Then the question is the depreciation relevant cost or not? If we come up with the decisions, no, it's not relevant cost, then we take it out from our calculation. Make sense? So that's the general idea with this relevant cost, irrelevant cost. So again, straight line depreciation of the car. Is it relevant? Is it not relevant? That's what we're trying to figure out. What do you think? Is it relevant or not relevant? Any suggestions? Irrelevant. Cost of the gasoline. Is it relevant cost? Let's think about it. If I take a train, do I have to pay it? No. If I take the car, do I have to pay the cost of the gasoline? Yes. So relevant. Annual cost of the auto insurance and license. So this person already paid to ICBC $1,380 for the insurance for the car for 1 year. Now, if she goes with the train, can she save this cost? Or if she goes with the car, can it have more cost? Is it relevant or not relevant? Irrelevant. For the insurance, usually what I'm saying to the people who still have that on the insurance, question for you. Obviously, you're going on vacation, hopefully more than 1 or 2 times per year. But if you're driving a car and you already pay insurance, did you ever have experience when you're going to the airport and some guy to approach you or some person to approach you, ask you, "Excuse me, are you going on vacation?" And you're saying, "Yeah, I'm going on vacation." For how long? For, let's say, 15 days. Do you have car insurance? Yes, I do. With ICBC, of course. Who else? Okay, I'm from ICBC. And because you won't be here 15 days, we would like to give you a refund for those 15 days that you're not going to drive the car. Did you ever have had that experience? Would you ever have that experience? Do you think that that's going to happen ever? No. Once you pay, you pay. End of the story. Maintenance and repair. If you drive it, you have to maintain it. If you don't drive it, it's sitting there. So is the maintenance and repair relevant for our decision? Should I take the car or the train? Yes, it is. Parking fee at school. This student, she paid $360 for the parking for the whole year. Is this relevant for our decision? No, it's not. It's a sunk cost. She already paid for it. It's irrelevant. Parking, not parking, is there. So far we have those 1, 2, 3, 4, 5 costs. Let's see what else she prepared. She also get, if she drives the car, the value of the car is going to go down per kilometer. If she doesn't drive the car, the value of the car is not going to go down. Is that a relevant cost? Relevant, yes. Round trip train fare. So if I take the train is going to cost me that much. Is that relevant cost? Absolutely, that's the cost of the other alternative. Now, benefit of relaxing on the trip on the train. When you're on the train, now you can spend more time with your cell phone, the most precious item that you have in your life, or you can bring your laptop, you can bring your iPad or anything like that, tablet. So many options. Don't bring the book, that's old fashioned. So, anyway, the point is you can do so many things when you're not driving and relaxing on the train. Is that relevant or not relevant? Relevant, but there's no value of money, right? We cannot measure it in dollar amount. So for that reason, we're gonna leave it. That will be that qualitative analysis rather than quantitative analysis. Cost of putting dog in kennel. Now she has a dog. She's living with a dog. In both scenarios, she doesn't want to take the dog with her. So she has to put it in this, that's not very fancy hotel, dog hotel for a few days, which is going to cost $40. Is that relevant cost? No. Why not? Because in both cases, she's leaving the dog. How she's going to go there and how much will be the cost to go there, it's irrelevant. Benefit of having the car in Windsor. Is there a benefit of that? Is that relevant? Yes, it is. Can we measure it? Probably not, but we can consider it. Hassle to parking the car. Now we have to, when we are somewhere, we have to find out we don't know where we are. We have to look for the parking spot. Probably we're not going to find it. We're going to look at here, look at there. Is that relevant? First, definitely relevant. Can we measure it? No. So for that reason, we're going to leave it. Parking cost per day when she's there. Is that relevant? Yes, it is. So let's summarize first. The cost of the car, sunk cost. So any depreciation, anything related to that one, it's irrelevant. Annual cost of insurance also irrelevant since it's going to stay the same regardless if she's using the train or going to drive. Cost of the gasoline, that's irrelevant. And if she takes that, cost will be disappear. And if she drives the car, it's going to depend on how fast she's driving and anything like that. Cost of the maintenance, definitely relevant. Monthly school parking, that's irrelevant since already been paid. That's a sunk cost, so that's irrelevant. What else? Declining the resale value of the car, additional miles that she take with the car. Yes, that's definitely relevant cost. Around trip of the train, a relevant cost because that's the cost of the other alternative. Relaxing on the train, yes, there's some value. We cannot estimate it. We cannot measure it. So for that reason, we're gonna leave it. The cost for putting the dog in the special place for dogs only, that's irrelevant because in both cases she have to pay that cost. Cost of the parking are relevant now, but having the car in the new place and trying to find the parking lot where to park, it's relevant, but it's hard to assign any cost to that. So for that reason, it's gonna disappear. So after we do this analysis and after bring only the cost that left, we're gonna find out that if she has to drive 460 kilometers, 230 back and forth, it's gonna cost a total $114.86. A round trip ticket is $104. based on the cost, on the dollar amount, based on the dollar amount. If this is you, what will be the logical choice? Car or train? Train, no questions about it. Now, this is based on the cost. Now, let's put the qualitative analysis, everything which is not expressed by the cost. And now it's you. And you see that relevant financial cost is 114, ticket 104. So you have $10 difference. What you gonna do? Drive or train? We already established based purely on the cost, train, no questions about it. Now, putting the cost plus all the other benefits, drawbacks of having the car, not having the car, quantitative analysis, qualitative analysis, you're putting all together, what you gonna do? Car or train? Still train, train still, okay? So if I have to tell you, if the cost is only $10, difference is only $10, I'm gonna go with car. No questions about it. Why? I want to be free. I want to stop wherever I want to stop. I want to go wherever I want to go. If I see something interesting, I'm just stopping and going and see it. If I feel like I want to eat something, I'm gonna stop and eat whatever I want. It's give me more freedom. And when I go to the new place, I'm more mobile. If I'm using only the train, then I have to go where the train goes. Can I go 200 meters left or right? I can't. Why? Because I'm stuck with the train. So for that reason, if the cost difference is only $10, most likely qualitative analysis will gonna push me to go with the car. But that's me. Now, that's one way you to make a decisions. Simply uh, look at the cost as avoidable, non-avoidable, relevant, not relevant. Bring the cost, see what's going to happen. Now, the point is that not all the time we're going to have so much information available. Sometimes we're going to have enough information to prepare the reports. But in order to prepare the entire financial reports, what we can see is we can extract the cost of the benefit and we can extract the saving and see which one is higher. Cost of the benefit, cost of buying something or the saving. The other thing that we have to remember is increase in operating income is not always going to come from sales. Cost reductions or be more efficient in the cost always also can bring operating income. So what that means? That means in this case, what they're doing is they're renting a new machine for $3,000 per year, which saved them $15,000 in direct labor. Is that profitable decision? To spend $3,000 and to save 15? Obviously, it's a profitable, right? Because the difference between saving and the cost is $12,000. So, do I have to prepare the entire financial statement side to see this? No, you don't have to. Which approach then are we going to use? We're going to use the differential approach, which is getting the benefits, getting the cost. Benefits, if the benefits are more than the cost, go for it. If the cost is more than the benefits, keep what you're doing. So for that reason, we're going to use this differential analysis because again, not all the time we have the entire information to prepare the entire financial reports, and that takes time. So using differential approach is desirable for two reasons. First, not all the time we're going to have information to prepare the entire income statement or a report. And by preparing that report, we can make a wrong allocation of the cost which not supposed to be part of our decision. So we can easily mix traceable with the common cost, and that can change our decision. Now let's start making decisions. First decision that we need to make is to add or drop a segment, or add a product or drop the product. One of the most important decisions that you have to make, because now you're the manager, since you're already almost at the end of this introduction in managerial accounting course. One of the most important decisions is whether to add or drop business segment, such a product, store, customer. It might decide, should I drop this customer, should I keep it? So let's see how relevant, which relevant cost should be choose. Now, due to the declining popularity of digital watches, this company, which produces digital watches, is not reporting profit for several years. Company thinking, should I discontinue this product line or should I not? Decision rule is, see where you are in the beginning. If you drop what you have, if that increase the bottom line or operating income, yes, eliminate. If decrease the operating income, don't. What's important then? We have to find out the contribution margin that we're losing, because the contribution margin is sales minus the variable cost, which is coming in. If the contribution margin loss is more than the cost saving, don't. But if the cost saving is more than contribution margin lost, then yes, go for it. Let's see how we're gonna do. This company, as we can see, losing. How much they're losing? $100,000. Only the digital watches, sorry. Only the digital watches department or segment losing $100,000. Why they're losing 100,000? We can have sales 500, contribution margin is positive 300,000. After that, they have the general factory overhead, salary, line manager, depreciation, equipment, advertising, direct rent, general administrative expenses, total of 400,000. So this division looks like losing $100,000 based on this report. Additional information available is that the total general factory overhead, which is $60,000, and general administrative expenses, which is another $30,000, in total $90,000. Those will not be affected. So if the company start producing these digital watches, this $90,000 will not be eliminated. They're gonna stay with the company. The other thing is, fixed general factory overhead and general administrative expenses will be assigned to another product. The other thing is that equipment that we're using to produce those watches has no resale value. And if we stop using this equipment, I cannot use it for anything else. So that equipment is worthless. I cannot even sell it because it has no resale value. Now the question is, should I drop this segment or not? Again, right now the segment losing $100,000. We already said 60,000 general factory overhead is not going to be safe, so those should be removed. $30,000 general material expenses should be removed. Depreciation of the equipment which you're using, again, since there's no resale value, I don't know why even it's on this report. Yes, for the financial statements showing to somebody else, yeah, we should show depreciation. But for the management purposes, there is no cash in the depreciation. And if we cannot sell it, then it's totally irrelevant. So if we make adjustments, how much of this cost will disappear? 60,000 will disappear, 30,000 disappear. That's 90. 150 disappear. So that's 140,000. It's going to move away. We're losing 100. If we remove 100,000, 140,000, what's going to happen? Let's see. If we drop this division, this contribution margin that this division producing or generate, gone. So we're losing $300,000 gone. Let's see what we're gonna save. Can we save on the general factory overhead? No, it's gonna go to another product. Can I save salary of the line manager? Yes, we can. Can I save depreciation equipment? There's nothing to save. Depreciation is sunk cost. I cannot sell the equipment. Advertising direct. Yes, I don't have to advertise. If I don't producing it, I don't have to advertise them. Rent of the factory space. Yes, if I don't produce them, I don't need to do that rent. I can stop paying the rent. And the general administrative expenses, well, they'll be allocated somewhere else. So what's happened? How much we can save? I can save the salary manager, advertising, or rent the factory. That's total saving 260. So if I decide to drop these digital watches, I'm losing $40,000. So should I drop the digital watches? Absolutely not. Why? Because if I drop it, contribution margin that I'm losing is way more than the cost savings. So for that reason, keep it. If we have to do the comparative income approach, then if I have the division, once I drop it, everything gone. Sales gone, manufacturer expenses gone, shipping gone, commission gone, contribution margin gone, zero. On the other costs, 60,000 factory stays. Digital watch is gone, 60,000 stays. 90,000 factory line manager gone. 50,000 depreciation stays. Advertising direct gone. Rent gone. General administrative expenses stays. So my total loss is going to be the cost that's going to stay with me is 140. Once I'm allocating this cost, which I shouldn't be allocating these costs, I'm losing 100,000. If I drop the division, my loss is going to jump to 140,000. So why is the problem? Because common costs are allocated to a segment which they shouldn't be allocated. Common costs are the general factory overhead, general administrative expenses. Depreciation is just depreciation. Again, there's no cash in the depreciation. So for that reason, once we eliminate those three, we come to conclusion that this division should stay. That's with the first decision. Second decision that you as a manager and you as a person making all the time is, should I make or should I buy? Should I eat at home or should I go outside? What should I do? Should I buy my own products, cook my own meal, or should I go outside eating somebody else's products, which I don't know what they are? I have no idea how they prepared, but it tastes so well and so tasty. So is it because of the products? Is it because of some other chemicals they're using? We don't know, but it's tasty. So when the company is involved in more than one activity in the entire value chain, we're talking about the value chain starting with the research and development and going all the way to customer support, means that the company is vertically integrated. Now the company has benefits to do everything by itself. Decision to carry out one or another activity out of the value chain internally rather than buying it internally is called make versus buy. So if we decide research and development to be from to outsource it to somebody else, or production to be outsourced, or some materials to be outsourced outside, that will be make versus buy decision. So what's the advantages? If I'm doing everything by myself, I have a smooth flow of parts and materials. Why? Because I know my production cycle. I know where to make a purchase. I know how much to purchase. I know my production. I can make everything smooth and nice. I can have better quality control. And all the profits is for me. So technically speaking, outsourcing, you start sharing your profit with somebody else. Now, disadvantage, obviously, the disadvantages will be the company might lose the opportunity to create this economy of scale, which means is to give some of the value chain function or value chain activities to somebody else who is very good at this, has a very good expertise, and we just to use that as our benefits, and and at the same time with available resources which we're freeing. So you have to understand, if I don't cook at home, that opens another opportunity for me, if I have those opportunities, to do something else. If that bring me profit, then yes. So let's say this company. This company has the following cost. Somebody prepare a report and they say, okay, we're making this part, which is a for a part, and that for a part has direct material, direct labor, variable overhead, depreciation, special equipment, supervisor, salary, general factory overhead. Altogether $30. Now, once we look at this, okay, that they're making $30. That's how much cost based on their cost report. Whoever prepared, that's how much he could come up with. Now, this special equipment used to produce this, manufacture this part has no resale value. So if we stop doing this depreciation of this special equipment, nothing's going to happen with it. With the special equipment, we cannot resell it, zero value. So the question is, should this depreciation still be in my report, or should I just get rid of it? Total amount of the general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by this decision. So whatever we decide to do, make it, buy it, the $10 is going to stay with us. We're going to carry it. So now $10 is the general factory overhead. Once we remove the $10, our costs become 20. Once we get rid of the depreciation, we're going down to cost of $17. Now, when we see this $30, and now the $30 based on the production of 20,000 parts. Now we have to replace those 20,000 parts, so we have to make a decision. I currently am making those 20,000 parts. Looks like it cost me $30. Totally wrong. It cost me more like a 17. Outside the supplier comes and say, you know what? I can make those 20 parts for you. 20,000 parts. The only thing that you have to pay me is $25. I can even give you a special deal, $24 per part, if you choose me. The question is, shall we accept the offer from the supplier and pay him $25 or 24 if he makes the special offer, or keep buying and keep producing it? I believe we already come up with that conclusion. So simply it's going to be, how much of this cost is actually relevant? If I'm still producing, if I'm still producing, do I have to pay for direct material? Yes. Do I have to pay for direct labor? Absolutely. Do we have to pay for the variable overhead? Yes, we have to. Depreciation special equipment. Am I paying for that? No. Can I sell it? No. Okay, supervisor salary. Do I have to pay him? Yes, I have to pay him $2. General factor overhead. Do I have to pay that? Well, the company pays it. Regardless if I produce this product or not, that cost not going to be affected. So how much is our actual cost per unit? It's going to be 1 and 9, 10. 5 and 2, $17. $17. Somebody comes and tells you, I can sell you for 25. That's great, but it cost me only 17. So you ask me $8 more for one single part, right? And that $8 per single part times 20,000 parts. The way I see it, you ask me for $160,000. If I have $160,000, why should I give it to you? I better save it for myself. Let's see the calculation, how they did. They going with the total. What's the total? If I make it, it's gonna cost me $9 per one unit, or 180,000, $5 or 100,000, $1 20,000, supervisor salary 40,000, 340,000. 340,000 divided by 20,000 units, that's $17 per unit. If I buy it, I have to pay $500,000 or 20,000 times 25. So the difference is 160. From where that difference comes, because we have 25 versus $17. That's $8 per unit. Over 20,000, that's $160,000 right there. And since the special equipment has no resale value and the general administrative general factory overhead is not going to be saved, we better eliminate that cost. So in overall, should I make it or should I buy it? Keep making it. Why? It costs you only $340,000. If I buy it, you have to spend $500,000. The question is, do you have extra $160,000? If you don't spend it. Keep it for yourself. That brings us to opportunity cost. Now, what's the opportunity cost? Opportunity cost is the benefit forgone as a result of taking one alternative versus another. Now, what's interesting with the opportunity cost? Opportunity cost, you don't have to pay for it. It's not actual cost, which is going as an outflow of cash for you. But we have to consider it. For example, right now you listen to me on this lecture. What you're missing? You're missing opportunity to go and work. When this opportunity, when your decision will be justified, the fact that you're sitting here and watching me, only and only if the benefits of being here in the class are more than whatever you can take from the job that you might have. So if you don't see some people, they decide to work. Why? Because they're thinking that the benefits or the dollar amount that they're getting per hour from the work is more than the dollar amount benefit that they're getting per hour from this course. And that's fair. They make the logical management decision based on the opportunity cost. So in this case, let's go back to this case because this particular scenario is not discussed here. So Currently, I should make it because the difference is $160,000. We can easily see it. Now, the question is, if I'm buying it, and that opens opportunity for me to make another product, from which product I'm generating $180,000. In that case, should I buy it? Well, definitely yes. Why? Because then the $180,000 that you may possibly make from the new product, it's gonna offset the 160 that you're losing for buying, but opens opportunity you to make the 20,000 extra. In that case, yes, go for it. But only in that case. So the special order is the one that is we're going to discuss now, the opportunity cost. Special order. What is a special order? That's a very interesting state in the economy, or very interesting point of sale on the economy, which has nothing to do with the cost volume profit analysis, has nothing to do with the break-even point. We're not going to calculate the break-even point for the special order. Why? Because the special order is something different. Now, what we need to know about the special order, a few things. First thing is, we can accept special order only if we are currently working below our capacity. So with that special order, we're gonna utilize the capacity that we normally not utilizing. That's one thing. Second, special order will be considered only and only when we are above break-even. Once we are above break-even, then any dollar that comes to the contribution margin is going to flow directly to our operating income. And the last thing is the special order is not gonna affect our business. Means none of our clients gonna find out about it. None of our clients gonna start chasing us. So why are you selling these people less than what normal selling price is? So how are we gonna do the special order? Same thing. As long as the incremental benefit is more than the incremental cost. So basically, we're going to chase how much exactly is going to cost us the special order, having in mind that we are already above the break even and we have the capacity. So we are fixed cost free. So what we're using, we utilizing the fixed cost. So what will be relevant for us? Variable cost. So let's see this. This company makes a single product whose normal selling price is $20. So in normal course of action, we're selling this product at $20 per unit. Foreign distributor comes and says, you know what? Can you make me 30,000 units for $10? This is one time and one time only order. It's not going to affect our regular business. Now let's see, do we have the capacity to do it? Currently, our capacity is 10,000. At the moment, we're making and selling 5,000. Do we have the capacity to make that special order of 3,000 units? So if my capacity is 100,000 and I'm currently making only 5,000, I have 5,000 units unused capacity. Correct? So is the $3,000 that this person asked me within the 5,000 units unused capacity? Yes, it is. Okay, that's first thing. Second thing, am I profitable at this point? When we look at the financial statement, yes, we generate an operating income. What that means to me? that means I'm above the break-even point, because the break-even point is when the sales are equal to the fixed cost and the variable cost. Okay, I'm above break-even point. I'm going to make myself a note. What that means to me? That means that I'm a fixed cost free. More units that I'm producing, those units not going to drag extra fixed cost. Fixed cost is already covered. With the current sales that I'm selling for 5,000 units, I already covered the fixed cost. So what that means? Every additional unit of dollar unit that's going to come to my contribution margin is going to flow directly to my operating income. Why? Because the fixed cost is going to stay 48, 48, 48, 48, 48, 48. The only thing that's going to start increasing contribution margin. $1 more in contribution margin goes directly to my operating income. So what do I have to do? I have to make sure that those units that I'm planning to sell at, and they're asking $10, the contribution margin has to be positive. So what that means, as long if, since they're asking me for $10, can I sell them for $10? That means if my variable cost in this case, because only the variable cost left, the fixed cost is covered. If the variable cost is the same or below, yeah, we are good. So what we have to do? How much is my total variable cost? Total my variable cost is 40,000. How many units I'm producing? 5,000. So my variable cost per unit is $8. They ask me for 10,000 units. They ask me for 3,000 units and they're going to pay me $10. How much is that per unit? $10 minus $8 variable cost, $2 per unit. Over 3,000 units, that's $6,000. Do I want $6,000? Do you want $6,000? Again, this calculation is very simple. You have variable cost is $8. Your selling price, they're selling you for $10. So the selling $10 minus the variable cost $8, that's going to give you contribution margin per unit of $2. And since I'm selling 3,000 units, which generating $2 per unit, that's easily transferred to $6,000. Again, the question is, do I want $6,000? Because if you don't want $6,000, I cannot make you get this offer. But if you want it, it's available for you, sitting and waiting for you to jump. So the special order, again, once we do the calculation, we're going to find out that we can work in the total. If I produce 3,000 units and I'm selling at $10 per unit, that's going to generate me $30,000 sales. $8 is the variable cost. Times 3,000, that's 24,000 units. 30 minus 24, that's 6,000. 6,000 divided by 3,000 units, $2 per unit, which is the sales price, 10 minus $8 variable cost. Now, again, this answer, we're assuming that the fixed costs are unavoidable and variable marketing costs must be still happening in the special order. So as you can see, we have here the marketing cost. In this case, we're assuming that those costs is going to stay with us. Most of the time, when we have a special order, since the sales are guaranteed, we don't have to incur those marketing costs. So the marketing costs, it might be avoided, but that's from the different scenario, not this scenario. So let's do a quick test on this question and this question alone. This company originally sells X lenses for $50. Variable portion production cost is $10. Fixed production cost is $18. Variable selling cost is $1. So up to this point, my variable cost is $11. $18 of fixed cost. Customer is coming to me and requesting 10,000 units. If I accept this order, selling cost gonna be eliminated. It's not involved. So this additional extra door, that's gone. So what do I have to make sure that I cover my variable production cost? But hold on a second. But this company, the special order would not involve any selling cost, but this company would have to purchase, or me, we have to purchase imprinting machine for 50,000. So we have to, this special machine for 50,000, we have to spend 50,000. Question is, what is the minimum price that we have to charge the client or the customer? In other words, below what price, at what point I'm going to start losing money on this sale? The capacity is not my problem. I have ample or idle capacity, more than enough. So what will be the minimum, the very, very minimum price that I have to charge this company, this client, at which point I'm not losing money? Well, let's see what's happening here. We're talking about here about 10,000 units, correct? My variable cost is $10 per unit. So I have to cover my variable cost. Also, I have to cover the 50,000, which is for the imprinting machine. So my total variable cost, if I produce those units, is gonna be $10 per unit times 10,000 units. So my total variable cost, if I can print it here, let's see if I can print it, my total variable cost is going to be equal to 10,000 units times $10 per unit is going to be $100,000. Plus, on top of that, I have to pay for this machine, which is 50,000. So my total cost from this sale, for this sale, is going to be $150,000. How many units I'm selling? That will be 150,000 divided by number of units, which is 10,000 units. That brings me that the minimum cost for those units was gonna be $15. So, since my minimum cost is $15, if I ask this client to pay me $14, am I gonna make money or gonna lose money? And in that case, the question asks, what will be the minimum price? Minimum price below on which we should not go with the negotiation with these customers. What's the point of we start losing money? Obviously, that will be $15, right? So we can go with $50, but that will be the rock bottom. That's it. $15. On the $15, we are kind of break even. So again, the calculation is if we go with the variable cost, 100,000 plus 50, 150 divided by 10,000, 15,000. The other way that you can go is I have $10 per unit. There's another approach. You can go with my variable cost per unit is $10. Then I have to get this machine, for which machine I have to pay $50,000. But with this machine are going to produce only 10,000 units. So how much is per unit? The way I see it is $5 per unit. So $10 plus $5 per unit, that's give me $15. As long as he pays me $15, I cover my cost. So are you gonna go and do it in total and then convert it per unit? Or are you gonna do it per unit in the first place? It's up to you. There's no one way to come up with this answer. Now, the tricky part is that in McGraw-Hill, you cannot solve the problem in different way when the question push you. So that's why I follow the instructions on the question and finish it the way it has to be finished. And that with special order. So again, the special order is as long as the price, selling price, covers my variable costs plus any additional costs which are dragged from that order, go for it. Now, joint cost. What is interesting with the joint cost? The joint cost is that in some industry, we're using the same common cost, or we're using this raw material. From that raw material, at some point, we start producing different type of products. When we producing different type of products from the same raw material, those products are called joint products. And at the point that those products become identifiable, it's called split of point. So in the example here is the joint input will be some oil, which is the common product, raw material. And at that point, at some point, we can identify it as a separate oil, gasoline, and chemicals. We're going to get this crude oil, and at some point we start seeing oil, gasoline, and chemicals. Oil now is a hot topic, so probably that's why this is in the slides. So once we getting the oil, later on with the oil, we can make a separate production and then do the final sell. Gasoline, we can do the final sell, and chemicals, we have a separate processing after that, and then final sell. Now the question is, which one we should choose to sell as it is, or shall we go furthermore? The joint costs are often allocated at the end of the production, which is based on the relative sales value. It's important to allocate those costs, but allocation is very dangerous for decision making. Why? Because it may look that the product doesn't make money, which is not entirely true. The other thing is you have to keep in mind is the joint cost up to the split off point is irrelevant for the decision making. Should I process further or should I sell as it is? What we're gonna do? We're only gonna sell the products which, after the split off point, generate positive incremental revenue. How are we gonna get the incremental revenue? Now, imagine for a second, I'm a dairy producer, dairy farmer. Sorry, dairy farmer. I'm a dairy farmer. What that means, I'm producing milk, and I'm selling the milk at $5 per liter. 1 liter, $5. At some point, I'm realizing, okay, that milk I can still sell it as a milk at $5, but if I produce butter, Now, the butter, I can sell it, that's per liter. For liter milk, I can sell it for $12. But to make it from milk to move it to butter, I need to spend, or I have to spend, five additional dollars. $5 additional. So the question is, should I keep selling the milk or should I move to butter? Now, we have to use incremental approach here. So currently, if I sell the butter at $12 versus the $5 that give me as a milk, I'm going to generate additional $7. But it costs me only $5 to produce it. I should have choose different number, but I choose $5. $5 to produce it. So if I continue with the butter, I'm gonna generate $2 per liter extra. So yes, I'm gonna continue with the butter. Let's put another product here. Let's pretend that besides the butter, I have option to sell cream. For the cream, I can sell it. I can sell the cream at let's say $8. But it's gonna cost me to produce the milk, who's gonna be, let's put it $4. So now what's gonna happen with the cream? With the cream only, how much additional I'm gonna generate? 8 minus 5, I'm gonna generate $3 additional. But it's gonna cost me $4 to produce it. So my profit's gonna be, in this case, is not gonna be profit. I'm actually losing money. And how much I'm losing? I'm losing exactly $1. So should I go with cream? No. Butter? Yes. Cream? No. Make sense? That's how we should approach those type of questions. So now let's go to the slides and continue. Example, we're going to use this example here. We have this company which having those two type of products. We have the sawmill cut logs from which unfinished lumber and sawdust are immediate joint products. Unfinished lumber can be sold as it is or can be processed further to finished lumber. Sawdust also can be sold as it is or processed further into presto logs. The information that we have for those two products is this. Now for this type of question, now what I'm going to prefer is to move to Excel spreadsheet. Just give me a second to get this getting this information here, and then I'm gonna move to Excel spreadsheet. My God, my mouse is lagging a lot today. I don't know what's happening with my computer here, but what I have to tell you is this. There was some updates on Excel yesterday on the Microsoft, and after those updates are done, half of my Excel tables, they don't work anymore. It give me a critical error, data loss, and all the other things. So I have to go back to the old Excel spreadsheet, see which one is affected by the new updates from Microsoft, and to figure out how to do it and how to recover the data, which is very, very, very unpleasant moment. But that's why I'm not very big fan of Microsoft. So regardless that, let's go to Excel spreadsheet and let's deal with our question here in hand. So we have this information and we have for the press to log lumber and sawdust. So we have the financial information for the sawdust and press to lumber. Everything is available for us. Now what we have to do is very simple. We have to find out where is the sales value at the split off point. And as we can see, for the logs lumber per log lumber, we can generate 140 as let me see, then believe I'm missing something, but per log lumber and sawdust. Okay, so this one is the here per log. We have the lumber and we have the sawdust. Currently, I'm making $140. If I process further, let's split now the information. If I process further, on the lumber is going to generate 270, and on the sawdust, we're going to generate 50. So the question is, how much is my additional revenue from both of those, from the lumber and from the sawdust? And as we can see from the lumber, my additional will be 270 minus 140, where on the sawdust gonna be simply $10. Next thing that I have to see is how much is my cost to process further. And as we can see, my cost to process further for the lumber is $50, for the sawdust is $20. Allocated joint cost, it's irrelevant in this case. So in that case, if that cost is irrelevant, let's see if we decide to go with the lumber and process it further, what's going to happen? We're going to generate extra $80 per log. That's not what we're going to generate, but 130 minus 50. We're going to generate extra 80. When if we do it with the sawdust, we're going to generate negative $10. So right now we can have clear picture what we should do. First, lumber, process it further. Where the sawdust, sell it as it is. If you sell it as it is, you're gonna generate $40. If you decide to process it further, you're gonna lose $10. On the lumber, if you sell it as it is, you're making only $140. But if you make it, process it further, you're gonna generate additional $80 from what you're generating now. So for that reason, again, process further with the lumber, done with the sawdust. The explanation will be right here. So once we get the sales price for the further processing, 270 versus 50, sales value at the split off point, 140, 40, incremental revenue, 130 versus 10, additional cost, 50 versus 20, so process further lumber for we're gonna generate $80 more. So just don't sell it as it is and get you $50. Move on. That's with the joint cost. Again, any product which additional revenue is going to cover the additional cost, go for it. If the additional revenue doesn't cover the additional cost, no. Which brings us to the next one, contribution margin. And what we're going to do with the products or, and how decide which product is more profitable when we're dealing with the constrained resources or we limited resources. Now, we already figured out that in life, the only limited resource that we have is time. But now we're in business, so the time not going to be only unlimited limited resource here. So when the limited resource restriction happen in the company, we're saying that the company has a constraint. When the machine or the process has a limit, we're saying that this is our bottleneck. Bottleneck, that means is holding the process, creating a constraint. The same way the bottleneck holding the liquid not to spill too fast. It's still gonna spill, but not so fast if there was no bottleneck. So how are we gonna deal with this? The general rule is when the constraint exists, you're focusing only and only on the product which maximizing the profit or having the highest contribution margin within the constraint. So for that reason, we not necessarily going to focus on the product which having the highest contribution margin in general, but on the product that has the highest contribution margin within the constraint that we have. So let's see this question here. This is the information for this particular question. Let me copy this and move it again to Excel spreadsheet. Let's see if it's going to go faster this time. That's not what I wanted, but let me try it the other way. Still not what I want. Let's try it a different way. Open the Excel here and copy the Excel from here and then move it to my Excel. Okay, I have it, so now I can share my screen with you. So we have this information. Let me make it bigger so you can actually see it. It's the numbers. Let's push it all the way to 18, and we have our information. Excellent. So what we have? We have this, oops, not the other way, that I want to insert some rows like this. So I have a product 1 and product 2. What's interesting with those products? First product 1, generate contribution margin $24. From where those $24 comes, $60 sales, $36 variable cost to produce it. Product 2, $50 sales, $35 variable cost, $15 contribution margin. As you can see, at this point, my profitable product is product 1. This is the most profitable product. That should be my choice 1, and this should be my choice 2 at this point. Ignoring everything else, all the other information that we have available. Only based on the information that we have up to this point. Now, I have my demand. My demand is 2,000 units of product. That's per week. 2,000 units of product one and 2,200 units for product two. What's interesting here is the demand. Okay, we have the demand. That's great. Gonna move it a little bit down. We also have the contribution margin ratio. We can easily calculate it. That's 40% here, 20/40 divided by 60, 40%, and that information is irrelevant at this point. I can easily eliminate that information. That's not my concern. I can see my demand. Additional information that we're gonna have in this question is we have the machine. I'm gonna copy this additional information. I'm gonna paste it for you right here as a picture. We have this machine, which machine is constrained resource. Why is constrained resource? Because this machine has capacity to produce of 2,400 minutes per week. That's it. That's the capacity of the machine. 2,400 minutes per week. The question is, since we have our demand, how many minutes per week we need? In order to get this, how many minutes per week we need, we have to see how much time is required. In order to meet our demand, if the product one, the demand is 2,000 products and takes 1 minute to produce one product, in total, we need 2,000 products time 1 minute. We need 2,000 minutes. I don't want this format. I'm gonna flip to this format here. 2,000 minutes here. And for the product two, since it takes only half minute, it's gonna be this one time half minute. I need 1,100 minutes to produce product two. In total, for both product, for both products, I need 2,000 plus 1,100, 3,100 minutes. Now my machine can give me only 2,400 minutes. So can the machine meet my demand? That will be the question here. Obviously, the machine cannot meet my demand. So what do I have to do? I have to choose between those two products. Which one should I produce in full, and what will be my product mix? Because again, the machine one, that A1 capacity is only 2,400 minutes. So we are short on minutes. And we short in fact 700 minutes. 1000 minus 2400, that's 700 minutes we are short. I'm having nightmare with this Excel. I'm so sorry. It's very, very, very unfriendly Excel today. So whatever Microsoft did is total disaster for me. Thank you, McDonald's, Microsoft for making my life easier. So where is the constraint? Constraint is minutes. What do I have to do? I have to find that contribution margin within the constraint. In order to do that, I already know that processing time which is required for each of the products. And my processing time is 1 minute for product one and 2 minutes, half minute for product two. Now the question is, how much is my contribution margin per minute? If for 1 minute I can produce only one product, product one, that means my contribution margin here is going to be exactly 24. On the other hand, with on product two, for 1 minute I can produce two products. So probably that will be, first one will be insert product per minute. That will be equal to one product. And here we can produce for 1 minute, we can produce two products per minute. So the contribution margin then per minute is going to be equal to 24 times one product per minute. And here it's going to be equal to $15 times two products per minute, $30. So the question now is, which one is my profitable product now? Is still product one. Now, as you can see, we moved to product two. Product two is my profitable product now, not product one any longer. So for that reason, I'm going to focus all my capacity in the beginning on product two. Once I satisfy the demand on product two, available capacity will be moved to product one, since the product one is my second desired product. So let's see how this is going to work. I'm going to get this chart here and I'm going to expand the chart right here. So we're going to start with available capacity. The available capacity that I have is in total, as we can see, 2,400 minutes. Question is, what can I produce with 240 minutes? First I'm going to focus, definitely I'm going to focus on product one. So I'm going to focus first on product one, product two. Yeah. And I'm going to produce the entire demand for the product two, which is 2,200 units. If I produce 2,200 units, since the product two takes only 0.5 minute, that I need 1,100 minutes to produce the entire demand for product two. Once I do that, let's see what's my capacity remaining. My available capacity now will be 2,400 minus 1,100 minutes. That will be 1,300 minutes. What should I do with those 1,300 minutes? Focus on product 2. Second is product, product 1, sorry. And since product 1, I need 1 minute to produce one product, I can produce maximum of 1,300 units. And that's how I'm gonna utilize my 1,300 minutes left. And after that, my available capacity will be 0. And that's the only way to maximize my profit within the constraint of this machine that I have. So what I have to do, if I want the winning strategy, for which product I should focus first and which one should I focus second, I should produce from product 2 entire demand, and after that, for product 1, only 1,300 units. Let's go back to the slides. So once we have the information about the 2 products and the information about the constraint, which is this machine A, then we can start asking ourselves questions. How many units per each product can be processed through the machine in 1 minute? We already have answer for that question. That will be 1 unit of product 1 and 2 units of product 2. Which product is going to generate the highest contribution margin within the constraint if we process it through the machine, product 1 or product 2? And we already come up with the answer that definitely that's product 2, because within 1 minute we can produce 2 products 2, and with 1 minute we can produce only 1 product 1. So 24 versus $30. Once we do this, next thing that we're going to see is how much is my contribution margin per minute. And once I see that contribution margin per minute is $30 for product 2, that become my desirable product, so I can emphasize my production on product 2 first until I satisfy the demand, and then moving to product 1. So what I'm going to do, first I'm going to produce the entire demand from product 2, for which I need 1,100 minutes. I have my capacity, which is 2,400 minutes from the machine. That means I have available left 1,300 minutes. With those 1,300 minutes, I'm going to focus on product 1, since that takes 1 minute to produce, and that's how it's going to give me my production model, if I can say that, my production model, in order to reach the highest possible profit. So only and only when I'm producing entire demand for product 2 and 1,300 products 1, only in that combination I can reach the maximum contribution margin available, which is $64,200. In any other combination, that contribution margin is going to be lower. Let's do one example with this question. We're going to have this information here. I'm going to copy the information. I'm going to move again to unfriendly Excel spreadsheet that I have today. And let's deal with this unfriendly Excel spreadsheet, which is today is a nightmare, but thank you again, Microsoft. Very useful. As you can see, or as you can sense, I'm a very big fan of Microsoft. So that's the information. Now we're missing the Excel spreadsheet from uh, the question, which I'm gonna extract it right now, and I'm gonna present it to you right here. That's not what I wanted. Let's try another way. Still not what I want. Let me try again. Doesn't help me at all today. Today I'm totally blocked. I really have no explanation what's going on with all the different updates and everything that these people doing is total nightmare. Every time when they're doing new updates, it's a nightmare. But you're gonna see it once you start working constantly with the documents, with the charts, with the Excel spreadsheets, with this, you're gonna see how uh, unpleasant the world can be with constantly updates, which are most of the time are totally useless. Okay, that's our Excel spreadsheet now. And that's the additional information that we have on the side. Let's bring it closely and close one to another and try to use this information. This company makes a reproduction colonial furniture from the selected hardwood. The company is supplier of hardwood who able to supply only 2,000 board feet this month. Is this gonna be enough? In order to find out is this gonna be enough or no, let's see our supply is 2,000 board feet. And that's all. That's all we can get from our vendor. Let me make everything equal now. Let's go with 22 and choose the same format so we can be on the same page all the way. All right, we have our 2,000 units. Okay, selling price per unit is $80. For the chairs, we have tables which are selling for $40. Variable cost, $30 for the chairs, $200 for the tables. At this point, we can easily calculate the contribution margin. And the contribution margin for the chairs will be $50 per chair and another $200 for the tables. And that's what we have. At this point, our winning product is obviously the table with the highest contribution margin. And the second ranking product is the chairs at this point. Now, what else we can see is that we have a board feet. And we're using 2 board feet to produce one chair, and we need 10 board feet to produce one table. Our current demand is 600 chairs and 100 tables. So what that means, every table has 6 chairs, in other words. The question is, how many board feet we need in total to produce our demand? Total board feet. To produce our demand for the chairs, we need 2 per chair times 600, and we need 1,200 board feet. To produce our tables, we need 10 board feet, and for, to produce those 100 tables, we need 1,000 board feet. So in total, board feet that we need for our production is 1,200 board feet. Sorry, 2,200 board feet. Our supplier can give us only 2,000, which brings us to the point that we are short. How much we are short? We're short with 200 board feet. Since the board feet is our problem, what we have to do? We have to find out, once you figure out where is your constraint, either the board feet here, either the hours, machine hours in the previous case, once we find out, okay, this is the things that hold us, then the next thing that you have to do is to calculate how much is the contribution margin within the constraint. Means that right now, once I know how many board feet I need to produce one product, I have to calculate the contribution margin per board feet. And if I need 2 board feet to produce one chair, my contribution margin for one board feet will be $50 divided by 2. Or for the chairs, my contribution margin is $25 per board feet. For the tables, divided by 10, it's going to be $20 per board feet. Now, that pretty much gives me the idea on which product I should focus. And as you can see, we're not going to focus on the tables anymore. Now we're moving back to the chairs. Chairs is the one who giving me the highest contribution margin per board feet. And that's how I'm going to use it. I'm going to use the chairs. I'm going to produce the entire demand for the chairs. And whatever left, I'm going to move to the tables. So let's do our calculation for the production. Production, let's call it schedule. Available, board feet available. Board feet available, we have 2,000 only. That's how much our supplier. So what we're gonna do with first the 2,000 board feet? First, we're gonna produce the entire demand for the table. We're gonna focus on sorry, not the table, the chairs. Chairs. And we're gonna produce the entire chairs, which is 600. To produce 600 chairs, we need 2 board feet per chair. That means 600 times 2. We're gonna use 1,200 board feet. Once we do that, we're gonna see how much available left. And we can see that it's left only 800 board feet. How many tables we can produce with those 800 board feet if we use 10 board feet per table. Obviously, the second thing that we're going to do is we focus on the tables, and we're going to produce only 80 tables. Once we produce the 80 tables, we're going to use the entire capacity of the board feet that we have, and available board feet will be at this point 0. And that will be our logical choice in order we to produce the maximum possible contribution margin with these two products within the constraint of the board feet that we have. Remember, the contribution margin per board feet per each of the product is the key point here. That's how you're focusing on the most profitable product. So let's go back to slides and see the slides for this one. You see, and the new thing that I just noticed is once I click here, you see this sign that's popping up right now. So my wild guess is they incorporated artificial intelligence in the Excel, and that will be the latest update on the Excel, and that's why make everything that is a little bit older to crash. So my strong suggestion for you will be careful now when your computer asks you for updates. Make sure you're making backup of all the things that you have currently. Don't let the computer to run the update by itself. Download everything or backup your information, especially Excel, and then let the updates go and keep a copy of everything. So most likely everything that you have is going to run under the old software, but with the new software is going to start giving you trouble. Just heads up on this. At least you save yourself the problems for yourself, rather than me to always try to recreate all the Excel spreadsheet that I already have, which is going to be a nightmare, but what can we do? Microsoft. So let's go with this one. Is it company supplier of the hard tool to be able to supply 2000? Is this going to satisfy our demands? Obviously, no. Why? Because we need 2200 board feet. So what will be the combination which can maximize our profit? We already come up with this answer. The logical combination will be 600 chairs, the entire demand of the chairs, and with the remaining capacity of the board feet to produce the 80 tables. So this is the rational calculation of what we just did on our Excel spreadsheet. Selling price, again, contribution margin is 50 and 200 for the tables. Board feet is our problem, so we're chasing how many board feet we need to produce one chair and one table. And we come up with the contribution margin per board feet. In the board feet is our constraint. $25 for chairs, then $20 for the tables. So that means we're going to produce the entire demand for the chairs, which is 600 chairs, which require 1,200 board feet. With the remaining 800, we're going to produce only 10 tables. 10 tables is per table, so we're going to produce only 80 tables. Last question that we have to deal here is that what if the supplier approaches us and say, you know what, I can provide you this 200 board feet that you're missing. What will be the maximum price that will be willing to pay for the hardwood to make those additional 20 tables? What do you think? Since we already know the contribution margin that we're generating per hardwood, that will be, we're talking about the tables. The tables we are short, and it's gonna be $20, and you're gonna be correct, right? If we pay $20 per board feet, that will be the maximum price that we'll be willing to pay. Anything above $20, we're gonna start losing money, correct? So what's gonna happen if we have multiple constraints? But before we dealing with the multiple constraints, let's see how we can eliminate the constraints. Eliminating the constraints obviously will be the key point when we have production and when we have a demand from the customers. So what we have to do, we have to improve the process or to add overtime or extra shift, hire new workers, purchase a new machine, increase the capacity, try to uh, try to mitigate that bottleneck and move from the departments that they don't have bottleneck into the departments if the uh, human resource gonna help you in this case. What we're gonna do if we have multiple constraints, that's the common thing in the companies. In that case, we're gonna use this linear programming to help us to mitigate those multiple constraints. How are we going to price the product? We're not going to go with the pricing. The pricing product, that's what we leave it for the intermediate managerial accounting. And that concludes chapter 12 for today. Now, there's one more thing that left, which is not part of today's chapter, but is part of the questions that you're going to have on the final exam, and that's called transfer pricing. Transfer pricing. Let's deal now with the transfer pricing. What's the transfer pricing about? Not, let me share the right one. Here we go. Transfer pricing. Only transfer pricing, cost of quality, service department allocation cost. That's not, we're not going to spend time on that. Transfer pricing is charged when one segment of the company provides goods or services to another segment in the same company. So the transfer pricing is not related to the third parties. The transfer pricing can happen only and only in the company that has a different departments. Is it gonna be multinational company or is gonna be national company? As long as they're one department that provides services, goods to another department, that's where the transfer pricing is gonna happen. The transfer pricing is the fundamental objective is to create wealth for the company by motivating managers to act in the best interest of the corporation. There are three common approaches for the transfer pricing. One is the negotiated transfer pricing. Second one is the transfer pricing of the cost of the selling division. And the last one is the transfer at the market price, what we usually selling on the market if you're the selling division. So in this case, we're going to have two divisions. Again, buying division, the one who needs the items, and the selling division, the one that provide the items. Both division, the selling division can sell it to the third parties, and the buying division can buy it from the outside parties. Having that in mind, we have to set up our limits for the transfer pricing to exist. So the transfer pricing upper limit always and always gonna be the market price that the buying division buying from the market. How much is the market price for the selling division? That's irrelevant. Because if the selling price for the selling division is higher than the market price that the buying division buying it, then the buying division never going to buy from the selling division internally. For example, if the buying division buying items, which is let me see where can I find. So if I'm the buying division and I'm buying from outside market for $20 and inside my other division selling it outside for let's say $25, I never gonna buy from my selling division at 25. Why? Because I can buy it from outside for 20. So for that reason, the maximum price that I'll be willing to pay for the item to buy it internally will be the price that I'm buying from outside. Now, in the selling division, they're going to have a cost. Let's say for the cost for the selling division is they're going to have the selling outside selling price is 25, but their variable cost, let's say, is $10. Then the contribution margin that generating is $15 for every product that they produce. Now, since we're within the same company, maybe the selling division will be willing to sell it to me at $10, which is the variable cost. In the $10 cost, they're indifferent because they're not gonna lose, but they're not gonna make contribution margin. So they're not losing contribution margin, they're not making contribution margin. So for that reason, when we're setting the transfer pricing, we're gonna have the upper limit and lower limit. Lower limit always gonna be the cost of the selling division, and the upper limit always gonna be the purchase price for the buying division. Which are the advantages? Somewhere in the middle, we're going to have negotiation between the two managers. Which are the advantages of negotiated transfer price? Try to preserve the autonomy of the division and give them potential for the both managers to come up with the price which will be acceptable in the both divisions. And that's also consistent with the decentralized system that we may have in the company. Also, managers, by negotiating the transfer price, they're likely to have better information of the potential costs and benefits of the transfer when they're setting up the transfer pricing for the products between each other. Now let's see the example with the transfer pricing. Imagine the two divisions in the companies are, one is the beverage or restaurant, and the other one is the pizza place. Now, the beverages, actually, that's the producing beverages producing the ginger beer. The capacity of production is 10,000 barrels. Variable cost per one beer is $8 per barrel. This division selling the ginger beer outside for $20 per barrel. Now the same company has also pizza place. Now the pizza place purchasing ginger beer from outside for $18. And the monthly consumption for the ginger beer is 2,000 barrels. So let's think about it. Now, we're making the ginger beer, we're selling it outside, and we're selling for $20. If we have, in our capacity is 10,000 barrels. If we have the demand for the entire capacity, and we're selling for 20, and the pizza place using the entire 2,000 barrels and buying from outside for 18, we're perfectly fine. In that case, the transfer price never gonna happen. Why? Because the pizza place never gonna purchase the ginger beer from us internally for $20 because we can find it outside for 18. And it's the best interest for the company, the ginger beer, to still buying it from outside for 18 because it's $2 cheaper to what we're selling. So if we selling in the entire production, then we're perfectly fine. And it won't make sense we to stop our sales externally to sell it internally for the price which is higher than we buying it from outside. Let's see the rules for the transfer pricing. Transfer pricing, the lower acceptable transfer price, now we have to set up the minimums, the minimum and the maximum. The lower acceptable transfer price will be the variable cost for the producing division, which the variable cost is $8, plus if they're losing contribution margin, we have to account for that contribution margin, and we're going to divide it by the total number of units transferred. The highest price always going to be the purchase price from the outside, which is $18. So now we have the limits for the highest and lowest. For the transfer pricing now to exist and to happen, the lowest price will be $8 if they're not losing any of the capacity, and the highest will be $18. Anywhere in between, there might be a transfer. So let's see the different scenarios. First one, if our ginger beer department has sufficient idle capacity, let's say they're producing currently 7,000 and capacity is 10,000, they have 3,000 barrels free capacity, which is enough to satisfy demand for the pizza place, which is 2,000 barrels. In that case, the ginger beer department will not going to lose any contribution margin. So the lowest possible price for the transfer will be $8. The buying division, they're already paying outside $18. So that will be the maximum price they'll be willing to pay for the barrel ginger beer. In this case, we have acceptable range for the transfer pricing between $8 and $18. And if the two managers want to make the transfer pricing to work, they can start negotiating. The other scenario will be if the ginger beer department has no idle capacity, means we're producing 10,000 barrels and we're selling outside to our customer 10,000 barrels. So if the pizza place come and say, can you sell me 2,000 barrels of ginger beer, what we have to do, we have to stop the regular sales at $20 and give it to the pizza place. So since we're losing those extra $18, $12, 8 plus 12 is 20. We're using those $12 contribution margin for the entire 2,000 barrels that we have to transfer internally. Then the minimum possible transfer price that we'll be willing to sell to the pizza place will be $20, or the contribution, the cost plus the contribution margin loss. That will be our normal selling price. The buying division, however, the maximum that they're willing to pay will be still the market price that they're paying to get the ginger beer from outside, or $18. As you can see, since the minimum price that the selling division will be 20 and the maximum price that the buying division will be 18, in that case, transfer price never going to happen. And in that case, we will not be in the best interest anyway in the company which would make any transfer internally. The last possible scenario is when there's some idle capacity. Means that now the ginger beer department has only 10,000 barrel capacity. So they're currently working, producing and selling 9,000 barrels out of 10,000 capacity. So what they can do, they can transfer 1,000 barrels at cost and another $1,000 at cost plus the contribution margin loss, which is $12. So in that case, for the entire transfer for 2,000 barrels, the minimum possible transfer price will be $14. Again, on the first $1,000, there will be no contribution margin loss, but on the second $1,000, it's going to be $12 contribution margin loss divided by the entire transfer. That's going to bring the minimum price of $14. Now, for the other division, the pizza place who's buying the ginger beer, again, they'll be willing to pay $18 maximum since they're buying from outside for $18. So as you can see in this case, there will be some room for negotiation between 14 and 18. But if you personally ask me, what my advice will be, the first 1,000 for which you have the capacity, transfer it internally, yes. But on the second 1,000, you sell it to the normal clients at $20 and the other division to buy it from outside for 18, and that will be the best interest of the company. Why? Because stopping no regular sales to your regular customers to do the internal transfer pricing is not the best decision for the corporation in the long term. Because today you stop the internal, the regular sales to make internal transfer, next day that customer can come and say, you know what, I don't want to purchase anymore from you because you may decide to do another transfer pricing, the internal transfer in a few months. So for that reason, transferring over the capacity is not a good idea. Evaluation of negotiating transfer pricing, obviously, it will be beneficial if the managers can sit down and negotiate the transfer pricing. But if the manager are pitted against each other, then there will be no cooperation between both of them. And when there's a disputes, which often happen with the company within negotiation process, most companies rely on the setting the transfer pricing by somebody else. Which are the drawbacks of this approach? So what will be happening if we switch doing the transfer at the selling division cost, or which will be the variable cost, or variable cost plus absorption. If we are above if we're on the capacity and we have to still stop the regular sales, we won't be considering transfer pricing. So that's leave the option, what if the selling division transfer the products at the variable cost? Well, using full cost of the transfer pricing can lead to sub-optimization, and the selling division in that case never going to see profit. And the cost-based transfer pricing doesn't provide any incentive for cost control. What's the other happen? What's going to happen on the other side when we're selling at the market price for the buying division? The market price approach works the best for the production or the service is so in the present form outside for the customers, and when the selling division has no idle capacity. And the market price approach does not always work well with the selling division. Again, we're trying to give the autonomy to our managers to keep the spirit of decentralized system, but at the same time, we're monitoring the situation so those managers can work in the best interest of the company, not on their personal interest. Transfer pricing can be used for the international purposes as well by triggering less taxes, foreign exchange, competitive position, better government regulations. In the internally, that will be greater divisional autonomy, greater motivation for the managers, and better performance evaluation. And that will be all for the transfer pricing. So what you have to remember for the transfer pricing and what you have to use is the how to set up the minimum transfer price and maximum transfer price. For the maximum transfer price, always remember, maximum transfer price always going to be the price which buying division purchasing from outside. Minimum transfer price always going to be the variable cost of the selling division. And then you have to watch for is the selling division has the capacity or not. If it has the capacity, only the variable cost will be component of the minimum price. If they don't have the capacity, then you have to consider the contribution margin loss for the units that they're losing it over the entire transfer. And that's with the transfer pricing, people. And that concludes this chapter, transfer pricing, and everything that we have to cover in this course.